If you had a choice between these two investments, which one would you choose? Choice number one, a beautiful finished house, retail ready for $1 million, or a house that is under construction for $20,000. Which one would you choose as an investment? Well, it's not a straight answer because it depends. It depends on how much it would cost you to finish the house. If, for example, it would cost you $80,000 to finish the house, but after the house is finished, it could sell for $1 million, the choice would be obvious. You would choose the house under construction because you would buy it for $20,000, put in $80,000 to finish it, and then you would be in for a total of $100,000, but you could flip it or sell it retail for 10 times your money. That would be an obvious choice because if you bought a finished house for $1 million right from the beginning, there wouldn't be much upside, right? And that's really the entire investment thesis for Plurilock Security. You see, in this market, you can use this analogy as beautiful finished house as a profitable company. Everybody wants to talk about it. Listed on the right exchange. You want to tell your friends about it. Versus unprofitable company that is on its way to become profitable. And in today's market, the difference between valuations for profitable company, where everybody wants them, versus the unprofitable companies that are on their way to become profitable is huge, and tremendous amounts of money can be made by buying companies that are close to profitability, buy them before they are profitable, and profit tremendously when they become profitable. Plurilock is sexy and unsexy at the same time. And here's what I mean. The industry that Plurilock operates in is unsexy because it's cybersecurity. I mean, cybersecurity. I don't find anything sexy about that, that industry. But you know what is sexy? The sexy part is the valuation. Today, Plurilock's market cap is about $13 million Canadian dollars. Now, let me put this in perspective. There are not very many or any MicroCap cybersecurity publicly traded companies that have a huge upside. Most of the companies that operate in the cybersecurity space already have billions of dollars in revenues, and they already have billions of dollars of market cap valuations. Plurilock is different. The market cap is tiny, only 13 million, but market cap alone doesn't really tell you anything. It's market cap is like a price. The price that you pay, and what do you get for that price? Well, with Plurilock, you get 70 million of revenues. They generated 70 million of revenues. And let me repeat it again. 70 million of revenues, and you can get it for $13 million market cap. Plurilock also has some of the most incredible clientele, and I'm talking NASA, Air Force, US Navy, US Army. So that's on the governmental side. Then they have Adobe, Microsoft, NVIDIA. I mean, that clientele is unbelievable. So it tells you from the start, this is a serious company because those entities would not be doing business with a company that wasn't serious and wasn't good and wasn't for real. Plurilock also has a lot of growth and a huge growth runway ahead of itself. If you are already a multi-billion-dollar company, how much growth do you have? But if you have only 70 million of revenues, there's a lot of growth ahead of you, especially in an industry that today, depending on the source that you look up, is a $300 billion industry that within a few years, it's going to be over $1 trillion. So the industry is growing. Cybersecurity threats are just increasing. They're getting more and more costly for companies that get attacked. So the demand is going up. And Plurilock, not only is it tiny, it is very much unknown. I bet you haven't heard about it. I haven't heard about it until recently. And also, it is very much hated by the investment community. All those things combined, that's what makes it sexy. Before I continue with this video, I wrote a 12-page investment report on Plurilock. I suggest you download it. The link to this report is in the description below. I suggest you read it in addition to watching this video. As I already said, one of the sexiest things about Plurilock as an investment opportunity is the cheap valuation. And one of the main reasons why the valuation is cheap is because, number one, the stock is down 97% from its peak, and the investment community hates it for a good reason. You see, the company went public in 2020, and it was this close to reaching profitability. And that's why I like to use the example of a house where, the Plurilock was a house under construction, and many of the companies on the venture exchange are like houses under construction. It was about to finish the construction. The market turned, the money dried up, and the company found itself in a difficult situation. So when I had the conversation with the CEO, I asked him this question, and I'm going to play you this piece of him explaining what went wrong.
We opted to go public, and the rationale for doing so was we wanted to acquire other cybersecurity solutions providers. It would provide a distribution channel to sell our own capabilities through it, as well as it would give us the ability to bundle other products and services, again, to go solve that problem for our customer. So we elected to do that. So we went public in late 2020. As it turned out to be a good time in the kind of the macro global markets to go public. And so that allowed us to close on 4 acquisitions. So a combination of using our share currency as well as the access to capital enabled us to close on 4 acquisitions. And in hindsight, I would say that we were 2/3 or 3/4 of the way successful along the strategy. Unfortunately, when the macro markets turned and equity prices fell really across the board and access to capital dried up, it prevented us from being able to close on any follow-on acquisitions. And that was crucial for us because we had not yet reached break even. We were hoping to do that with some additional acquisitions that we were looking at doing. But without that access to capital, we were unable to do so.
Because the market turned and because Plurilock was unable to complete the final acquisition, the company never reached profitability. Soon, it ran out of cash, or the cash balance declined significantly, and it forced the company to come back to the market and raise more money. During the time when investors drove down the market cap of the company to $2 million, at that time, the company raised $5.5 million, significantly diluting the existing shareholders. The share count went from 10 million shares to about 37 million shares, and that's before the warrants get exercised. But tremendous dilution. But that's the recapitalization that recently happened. And also, there was a 10-to-1 rollback. So in other words, there used to be 100 million shares, but then after the rollback, it became 10 million shares, and then the dilution happened, and now it sits around, 37 million shares. That's what the 13 million market cap, based on today's stock price, is based on. But that's also why I used an analogy of a house, because Plurilock was like a house under construction that was purchased for that $20,000, but then additional money, that additional $80,000 was injected into the company in order to bring it to profitability. So for our numbers, the construction of the Plurilock house was $2 million, 5.5 was injected. Unfortunately, the dilution was created for the existing shareholders, but now the company is sitting with, additional $5.5 million of capital. In your investment presentation, you have certain mentions to working towards EBITDA positive. And I know this is a touchy subject because usually things take longer than people anticipate, but I was wondering if you could give us any color as to, what can people expect on that front?
Well, what I can say is that we're laser focused on getting to first adjusted EBITDA positive, and then to EBITDA positive, and ultimately to cash flow positive. So that's kind of the sequence of events. And again, if you kind of look at the comments from the earlier part of the conversation, we're choosing not to over invest in research and development and sales and marketing of our product. We are instead choosing to grow our critical services organically. We're seeing good growth there, and ultimately we are growing gross profit both on a dollar basis as well as a percentage basis. So these are the actions which we believe will take us to getting to adjusted EBITDA positive. Certainly, we've heard from both our shareholders as well as prospective investors that it is a haves and haves not market right now, and we believe that we'll be rewarded, once we achieve that. So that is the focus. It's the number one focus for us as a company.
Reaching EBITDA break even or profitability break even is a huge deal, especially in this market. The difference in valuations that investors assign to unprofitable companies versus break-even companies is night and day. And that's because when a company is break-even, it doesn't need to go to the market to raise more money, right? So if Plurilock can achieve EBITDA neutral, which might not sound like a big deal to you, it is a huge deal because, for example, this is a third-party analyst report that was written in the past. And in this report, the analyst was saying that Plurilock should be valued at 60% of revenues. Now, today, based on the market cap versus what the revenues were in 2023, Plurilock is trading for about 18% of revenues. So any sort of re-rating from that level when EBITDA neutrality is achieved would be a huge deal. If Plurilock were to trade at 30% of revenue, that would be massive for the current shareholders. If it were to trade for 50% of revenue, that would be even better. 60% would be even better. So achieving that level of success, while it's a stepping stone towards profitability, it is a huge deal. If you look at the company's income statement from 2023, you can see that total operating expenses were about $14 million. Now, last year, a new CFO came on board, and the company announced certain cost containment that would lead to about $2.5 million of cost savings. So if we subtract that from close to $14 million, the company needs about, $10 to $12 million of gross profit in order to reach break even. Now, before I get into the details on how the company is going to achieve that, I posed the question to the CEO to talk about the new CFO and why he was important to Plurilock. You do have a new CFO, and you mentioned before that you wished you found him earlier. So talk about this. Why? What has he done with Plurilock since joining?
So Plurilock has seen a lot of growth, particularly over the last 2 years. We had acquired 3 companies in 2022 at different parts of the year. It wasn't all at once. And so going into 2023, we had effectively 4 companies that we were running. The existing company plus the 3 acquisitions. And it is a lot of work behind the scenes to take those new companies, integrate them, integrate the systems, integrate the processes, integrate the people, do change management, making sure that nothing gets dropped, because while you're doing all this, you still have to run all these businesses themselves. You still have to satisfy customers and deliver. So it was a lot of work. Scott, who joined us as our CFO last summer, has been phenomenal. And he, even within his first 90 days, from joining last summer, had identified approximately $2 million of cost reduction through the duplication of systems and processes. And I think the other thing to note there is in addition to cost reduction, one of the other things that Scott has done is actually to create capacity. So one of our secret weapons is that we have 2 offices in India, which we're able to use for back end. And so Scott in particular has been phenomenal at growing capacity. So we're actually able to do more with less, but also kind of add some capacity. So it's not just everything on one person's shoulder or etc. So that was a change that we made in the summer of last year. You reported on some of the progress of that this past fall. I think what we haven't necessarily reported on was actually the velocity increase through just day-to-day operations that we're also seeing, which again, is not necessarily easy to see from the outside, but certainly has been really great to experience internally.
When you look at Plurilock's income statement and you look at the gross profit, in other words, you have revenues minus cost of sales, you look at the gross profit and you look at the gross profit margin, it's not a sight that you would get excited about. If you compare it to some other companies, some great companies like Adobe, they have incredible gross profit margins. You look at Plurilock's income statement and you want to cry. You want to say, Mariusz, why are you showing it to me? Such low gross profit margins. They're never going to be profitable. Well, you have to understand the business model, because Plurilock is not the only one that has this business model. You see, Plurilock is in a VAR business. VAR meaning value added reseller. It is in the reselling of things business. So it's not like a recurring revenue business. So for example, MicroCap explosions, which by the way, you should sign up for. It's my business, right? You pay me a yearly fee to access investment ideas. For me as a business, when you pay me, that's my revenue. I don't really have any costs associated with this because the infrastructure is already built. So an additional client doesn't cost me anything. There's no cost of sales. So my gross profit margin is huge. It's incredible. But if I were to be a reseller of cars, right? So let's say I am reselling a $20,000 Honda Accord, right? I buy it from Honda for $20,000 and I'm going to turn around and resell it. Well, how much do you think I'm going to get for that car? Do you think I can resell it for $100,000? Not a chance, because there's hundreds other dealers that are also buying from Honda, and nobody's going to pay me $100,000 for a Honda Accord when they can go to the dealer down the road and get it for maybe 25 or 23 or 22. So the gross profit margin for reselling cars is tiny, right? And that's the kind of business that Plurilock is in. It is reselling, it is in the VAR business, it is reselling somebody else's cybersecurity products. That's why the margins are so tiny, because those products that are developed by all the other vendors are also offered to other companies that are reselling cybersecurity products. So Plurilock cannot overcharge. In order to stay competitive, it has to make small margins on this. But if I use the example of reselling cars, but how could I, if I'm reselling cars, increase my margins? Well, what if I added services that customize the cars? For example, if somebody wanted to have something like this done, do you think Honda would do this? No, you would have to go and have it custom made, right? It would have to be a professional service. And on that service, guess what? I can charge much higher gross profit margins, right? I mean, that's how dealers make money. They don't really make money on cars, but they make money on service, right? So if we look at Plurilock's, again, gross profit margin, notice that it went up from 7.7% in 2022 to 8.31% in 2023. Why? Because of one component, the service component. They call it critical services segment. It used to be called professional services, but recently they renamed it critical services. So in other words, it's offering something else to the cybersecurity products. I mean, think about yourself. If you're buying a cybersecurity product, there's so many of them out there, right? Plurilock can add value. They can help you pick it. They can help you maintain it. They can help you customize it, right? That's an additional service. For that service, the margins are much better. Just reselling the equipment, the gross profit margin can be between 5 to 10%. But critical services segment, the margins on this can be 35 to 60%. So the key for Plurilock to increase gross profit and gross profit margin is to offer more of these professional services, these critical services, as a percentage of total revenue. And that's really the key to building shareholders' value, getting the company to EBITDA positive, and then getting the company past EBITDA positive to significantly EBITDA positive. And if you look at this component is already growing. It is the fastest growing component. In 2022, this critical service was only 742,000. Actually, the prior year, in 2021, it was only 300,000. So we went from 300,000, 700,000, and then in 2023, it was almost 3 million. So 300, 700, almost 3 million. It's the fastest growing segment. Because of this, the overall gross profit margin went up from 7.7% to 8.31%. Now, overall, as a percentage of revenues, this critical services is still very, very tiny. In 2022, it only represented 1.1% of total revenues. And in 2023, it represented a little bit less than 4%. Now, so obviously the next thing is, like, how big can it get in relation to total revenues? So to answer this question, I actually looked up some other VAR businesses, again, value added reseller businesses. And it's not necessarily, I couldn't necessarily find it in the cybersecurity space, but there's other, value added resellers that resell other things like computers and things like that. So I looked into their total revenues and how much of their revenue was for professional services. So for Aero Electronics, critical services were about 23%. For Inside Enterprises, they were about 17% of total revenue. For Jupiter Networks, they were about 35%. And for CDW Corporation, they were over 8%. So I took an average of that, and I think it's reasonable to assume that Plurilock can reach or can shoot for 21% or 20% of total revenues to be coming from critical services. Now, today, it's less than 4%. So 4% to 21%, you can obviously see a lot of growth opportunity. When I was researching your company and looking at your critical services as a percentage of total revenues, I kind of wanted to get an idea of where the company can shoot for or what investors can expect. And I looked at other VAR businesses, and I kind of saw a range that some had as low as 8% of their revenues coming from professional services, while others were closer to 30%. And I figured that maybe Plurilock could achieve 20% of revenues from critical services. Am I even close to what you think you might do?
Well, to clarify, I think you were talking about the gross margin percentage overall, correct?
No. I'm talking about the percentage of revenue, of total revenue, how much can come from critical services.
Right. Okay. Yeah. So, I mean, listen, the answer is yes. I think it's certainly possible. I think really it comes down to where are we going to focus our time and attention. If we continue to be more of a VAR rollup, then I would expect that the percentage of revenue from resell versus services would probably be disproportionate. But really, what we're saying is that we already have a great distribution capability in place today. And the focus where we're spending our time and attention is growing critical services. And so our expectation and hope is that we're going to see a lot more growth from that section. I think really the question is there any ceiling on how big services could get to as a percentage of revenue? And from my perspective, the answer is no. There's nothing inherently stopping us from getting to 20% or 30% or 40% of revenue from services. Like there's no constraint there. Really it's just where we're focusing time. Now, one thing that people don't recognize is that business model is actually very, very sticky. In comparison to a Netflix subscription where you're paying $5 a month or $10 a month and it hits the credit card at exactly the same time, at exactly the same day every month. The VAR business model on paper appears like it's a one-time sale. You sell a server, you sell a firewall, etc. It's one time. Practically speaking, the question you have to ask is, can that customer survive without technology? Can that customer survive without having the right cyber defenses? Can that customer survive without having cybersecurity software that they might be required to for insurance purposes? And the answer is no. Every business now depends on IT, and in fact, every business now needs cybersecurity products. So what is evident when you peek back behind the curtain is that it's a very sustainable business model. The acquisitions that we made actually have a very long tenure track record with those end customers that they are servicing, and it becomes extremely repeatable. It's not recurring, but it's extremely repeatable. So that's just the characteristics of that business model.
You mentioned your clients are sticky, and I think this is important for people to understand, because as you said, on paper, it looks like you have a one-time sale of hardware, but in reality, your clients are sticky. I remember talking to you once. You gave an example of a government client that one of your engineers wanted to retire, but they wanted him to stay on. I think it's a great story. Can you tell the story again?
Well, it twice. So we have a government client, and we have an engineer who's been providing critical services to the in that particular case to enable a large chunk of the workforce of that government client to securely to work, and that person has tried to retire twice. And the client has come back both times and said, no, we just need another 6 months, another 12 months. It's a really good indication and an example of the fact that technology is ever present, and the ability to maintain and update, keep secure, patch, etc., is crucial to our downstream customers. Even for technology that one might think, well, this is a temporary fix, and we'll move to the cloud later on. One of the jokes that we have here is that there's nothing quite as permanent as a temporary fix. And in a lot of our clients' cases, something that they think, well, that'll be there a year, 2 years, 3 years, ends up being 4, 5, 6, 7. That very, very practically, one of our most recent critical services engagements, we discovered during the engagement servers that appeared to be from like the 1970s or 1980s. It actually predated some of the engineers who are working on the project. So that's how old some of this technology can be, and how sticky it is, how difficult it is to replace. But for organizations like us who are there to provide value to our customers, it becomes a very stable and repeatable business.
Why are the clients interested in the critical services component? Why wouldn't they want to do it in-house?
Well, a lot of times they don't have the talent. In cybersecurity, there's over 3 million cyber jobs unfilled, and that's up from 1 million jobs unfilled a year or two ago. So there's a growing gap of capability of qualified cybersecurity engineers to be able to do the work. So that's just the first part. The second part is that in a lot of cases, our clients are not particularly in exciting industries. So we might be working with a semiconductor company or a manufacturing company, and it's difficult for that organization to attract top talent in a non-core part of the business. If you're a semiconductor company, you're going to put all your emphasis on trying to hire the best semiconductor engineers. You're probably not going to put a lot of time and attention to hiring cybersecurity engineers to protect your semiconductor companies. Plurilock is in a bit of a different spot. Part of the value actually of being public is that we just have more notoriety. People are a little bit more aware of us because we have a bit more of a presence, and we're in a very exciting space. And so as a result, we can attract people. We have a great culture, and it's one that's purpose built for cybersecurity. And so just from a culture perspective, we're able to win out. Second, in a lot of cases, our clients, they might have OpEx dollars to spend, or they might have CapEx dollars to spend. It's sometimes easier for our clients to spend CapEx dollars, bring in outside consultants, because they get to account for it differently in their P&L. Even though it's more money, it's better for their for their public image, and so they might want to go with an outsourced company like us. I think the third thing, and this really speaks to the track record over the last 4 years, is that Plurilock has a well-known reputation for working with the Canadian government, the US government, and very large and notable and critically important commercial organizations. And so we're able to bring the experience of having worked in the Canadian government, the US government, and large commercial enterprises to bear on a single semiconductor company, when really all they have to work with is what they're doing within their own 4 walls. And so in a lot of cases, the critical services team from us provides disproportionate value simply by the fact that we have a wide variety of experiences that we're able to bring to bear on that one customer. So it might be faster, it might be cheaper for them to potentially spend more money on an hourly basis or on a monthly basis with us, because their time to value is actually a lot faster. And I think the last thing that I would say is that Plurilock today, we really sit at the intersection of business, technology, and geopolitics. We have a very unique set of skills and experience at that intersection, and that's proving to be very attractive to our customers today.
In conclusion, here's what you have. So Plurilock is a interesting business, unsexy business with a sexy valuation. I walked you through some of the history, recapitalization, why the dilution happened. I talked to you about the business. It's really 3 business lines. The VAR, critical services component. There's another component, which is their own software. I didn't talk about this because it's not important right now. They have a very small revenue from their own software, but I didn't talk about it because that software division, even though it has higher margins, it requires capital to grow it. So right now it's put on the back burner. It's not important to this investment thesis, but that's why I didn't talk about it. I showed you how the company wants to become EBITDA positive and how it's hugely important for the re-rating, for the valuation. But then at the end of the day, it's not just EBITDA positive. The company wants to become significantly EBITDA positive, okay? And the end goal is to either be very, very much re-rated by the stock market, and if that doesn't happen, to sell it to a private equity. And generally, companies that have 10 to 15 million of EBITDA become very interesting targets to acquisitors that are looking for growth. So that kind of gives you a roadmap of where the company wants to grow. Grow the revenue significantly to that range so that it can get acquired. And if it reaches, when it reaches that level of, EBITDA, well, you can do your own calculations what the company can sell for to a private equity. I can't do this for you. Now, what you have in front of you is a little spreadsheet that I put for you. You can download this spreadsheet by clicking in the link in the description. Now, here you have the current revenue profile from 2023. I kind of estimated it because remember, I took out completely the software portion, which is like about 1 million, 1.5. I completely took it out. I want to ignore it. So I estimated the VAR business about 67 million, critical services about 3 million. So about 4% of total revenues are the critical services, right? Here I have the margins. I took it on average, about 7% margins for the VAR business, 40% margin for the critical services, for the combined margin of about 8%. That's kind of where it is. So that's how the gross profit is generated, right? Now, that's where we are today, okay? On the projection side, you can run various different numbers. So for example, and now these are not projections by the company, but if you believe in cybersecurity, if you think they're going to grow and expand the margins, run some numbers. So for example, let's say, let me just use 100 million here. 1, 2, 3, 1, 2, 3. 100 million of VAR business, and let's say 25 million for the critical services. That would bring it to about 20%. In line with what I was talking about. I leave the same margins. That would be a gross profit about 17 million, right? Then you have to decide on your own how much of that gross margin could result in a positive EBITDA, okay? Now, play with those numbers. Now, why can't I give you projections? Because I am under IR contract with this company, okay? The company awarded me an IR contract to bring awareness to this company. So because of that, I can't give you projections because the lawyers are going to be all over me, okay? So, but you can do this. You can play with the numbers. Let's say it's 1, 2, 3, 1, 2, 3, 150 million, 35 million of of maybe 37 million, 1, 2, 3, 1, 2, 3, because I'm going for about 20%, right? Then that would bring the total to like 187 of revenues. That would give a gross profit margin of about 25 million. How much would it become as an EBITDA? It's your job to figure out. Download this, play with this, enter whatever numbers you want, and it will give you an idea of what this company can sell for, in to a private equity if they are successful in growing overall the VAR business, increasing the amount that critical services segment takes up as a percentage of sales, because right now it's tiny. It's about 4%, and they were surprised. They were surprised by how much demand there was from clients for that critical services. You see, before this recapitalization, before the CFO came on, their kind of focus was actually very much on their own software. In the past, the investors were in it for their own software. But as I said before, their own software requires capital. And today, the market doesn't want grow. And if you want to grow your own software, it's like growing a little baby. Investors today want the 5-year-old baby to be an adult today. So that's not going to happen, okay? So that business cannot grow. So the focus today is to take the critical services, grow it as a percentage of existing client revenue. Those clients want that, so they can grow that. Then also they can grow the entire VAR business while also growing the critical as a percentage of the total. The goal is to reach profitability, EBITDA even, EBITDA neutral first, then go into EBITDA positive, and they either get re-rated by the stock market or they sell to a private equity. That's it for this video. I hope you enjoyed it. Make sure you leave me a comment in the comment section below.